guys. Well, no bad vibes to start the morning. So everybody's got their morning coffee and they're excited to talk mortgages. I know that that's typically the first thing I love to talk about in the morning. So bear with me. Let's get into it. So with the mortgage world, it's so funny because on the outside looking in, one of the biggest conceptions for most people is there's not a lot of change. Well, rates go up, rates go down. There's the odd guideline that you couldn't be any more wrong if that's your thought. And not to call you wrong first thing in the morning, but at the end of the day, this is the reality of the mortgage world now, which is it is a constant evolution behind the scenes, what you can see, what you can't see, how lenders look at things, and so much more. Now, we got a lot to cover today. I got a little bit ahead of myself. We got a lot to cover today. So here's what you can expect in this packed conversation. And as Taylor mentioned, I'm really interactive. I love if you guys found me. You can find me on the Instagram handle or YouTube handle that's noted below. I can also find you on that one. And ask me any questions you have after this presentation. With that being said, we're going to talk a little bit about the biggest fear that most people had going into 2024. And yes, it was rates, but not exactly. It was actually renewals and what's going on there and what we can expect. We're also going to touch on a few concerns that people had going into the year as far as investors. What is going on with the whole fixed rate, variable rate consideration, and what can we expect going forward? A quick little synopsis of bond yields, so how these are actually going up and down and why this impacts rates. I realize that a lot of people aren't really certain on this, so we'll get into that. And then last but not least, the bets that you're going to be making. So where should you go and what should you bet? So hopefully we can fit that into 20 minutes and we'll get going right away so we have time to get through it. So let's get into it, shall we? One of the biggest fears for most people coming into the year, and in the news, if you believed it, was constant. It was everywhere talking about the 2024, the beginning of the renewal boom or crisis. Every news article, honestly, between September until December, was plastered all over the place, constantly reminding people that there are mortgage renewals that are coming up, and this is going to be the crash of the real estate market because no one is going to be able to keep their payments. They're going to be foreclosures and on and on and on and on. And now, we've already seen now 3 months into the year, this couldn't be any more far from the truth so far. So far. But here's a little snapshot just to kind of show you how many Canadians are facing renewals at higher rates. Now, I want to preface by saying one thing really quickly here. I've got a graph that shows insured versus uninsured. Insured are those folks who purchase properties, typically speaking, with less than 20% down payment, therefore took a 25-year amortization. And then uninsured are those who either bought a rental property, a 30-year amortization, or a home over $1 million. What's interesting to note is those folks on the left-hand side, they usually started with a 25-year amortization. So they have one huge advantage right away, which is they have the ability to restructure or refinance their mortgage back to 30 years, therefore increasing or decreasing their monthly payments. We'll talk a little bit more about that when we get into this here, but I kind of want to just jump into it. Like this straightforward. This is not a crisis. I've talked to a lot of families and there have been some concerns, but for those who have been looking at preying on people because of renewals, I'd like to just dispel the myth right away to suggest that this is not going to be any kind of crisis. It is a shock. There is no doubt about that. And I'll talk a little bit about what I've seen. But for the sake of conversation today, it's not something that is causing any major foreclosures or people to sell off or anything of that nature. Now, per an RBC article, at the end of the day, they suggested that most people will see at most a 20% payment shock if they utilize one of those options, such as consolidation, mortgage amortization extension, which means taking your mortgage from 20 to 25 or 25 to 30 years. They reduce some of their expending. They talk about government relief measures, though I've never seen that in action yet. But at the end of the day, what I've witnessed is that the vast majority of people that we're talking to in a variety of different stages of their life have not been unable to make their payments on these new mortgages, even when they're going from rates of 2% to as much as 6%. So it's an interesting conversation that was coming up, but it hasn't necessarily translated into any changes from there. Now, one of the biggest things to look out for is these fixed rate, variable rate mortgages. So back to the original graph, we can see there's a lot of people coming up in 2025, and that wave will be the first wave of people who actually witness and feel the impact of what's happened when it comes to a VRM variable rate mortgage, which is a payment or a rate where the payments remain the same. Now, those folks, they saw their payments remain remotely close to the same or maybe slightly adjusted it. They will likely be in for the biggest shock when it comes to 2025 because their payments have remained relatively low and they've been paying off very little interest. So if we didn't see a significant amount of equity growth or any equity growth, it might limit their options. Now, we have 2 to 3 years, and based on how this year is starting, I don't see that as being a major concern, but that would be the only place where there might be some cause for consideration. Now, looking at a couple stats here, just to kind of walk you through it, we got 16% of mortgage holders set to renew in the next year, 15% in 12 to 18 months. Most Canadian mortgages are fixed. So 75% of people, we got about 20% of people considering or open on variable rate mortgages. And then a few more stats to kind of walk you through what people are thinking. Now, what's interesting is I think these stats are a little bit delayed and they could have come from the fall when rates were still going up or close to going up, because I am not hearing very many people talking about switching to a fixed rate right now. In fact, it went from getting 10 to 15 calls a week to maybe one, maybe two a week. And it's from people who are have been away or just not paying attention to the marketplace, or who knows, maybe they haven't been paying attention to their mortgage and they just got their annual statement. So I'm not seeing that happen very much. I am, however, seeing, and it suggests here 76% of people are cutting back on spending and tapping into savings. This is a real thing. And there's no doubt there have been a lot of, excuse me, sorry, a lot of families who have actually had to make serious adjustments to their lifestyle as a result of what's happening in the variable rate marketplace. Now, expectations over reality. A couple things that most people know, and this probably won't be surprising, is that Canadians pay their mortgages before anything else. And I've seen this. I see people's applications every day. Typically, I see around 150 applications a month. And in doing so, I get a chance to see what they're doing or what they're not paying. People will let their line of credit sit, they'll let their credit card sit, they'll let other things sit, but they will pay off their mortgage. And we see that over and over and over again. I was talking to a lender the other day, one of the monoline lenders in our country, and they were letting me know about their statistics, which have barely budged at all in regards to foreclosures over the last year. So another interesting consideration there. The impact as far as the actual files, we are seeing day to day, we were, I should say, for the second half of last year, substantially less secondary properties for the quote unquote average Canadians. And you can take that as you will. But what I've seen is that, your average working class Canadian, defined as whatever city that you're in right now, is not buying that second home or secondary property or vacation property or thing of that nature that they were in 2020 and 2021 in the first half of 2022. But in fact, we are seeing more of the folks with higher earning potential and or great savings abilities considering looking at those options now in the first part of 2024. So we do still note that a lot of Canadians see their primary home as an investment, right or wrong, but they are considering that. And again, that's another reason why they want to hold on to their house. They'll do anything without having to rent if they own their property right now. So another consideration, which is really interesting, and I know that some of the other presenters will talk about more real estate prices today, but the interesting thing we've heard consistently is Canadians can't afford their mortgages. And if you look at this little graph right here, when it shows the mortgage affordability based on median income going into 2024, you can note here that we are still extremely high as far as lack of affordability in the overall marketplace, although we came down from 2021, 2022 heights. Yet, why are we seeing house prices continue to go up? Because the reality is we have seen, in the most part, certain incomes actually increase. And at the end of the day, people adjust to new environments. Folks that we're talking to today, they have no understanding of 1.5% rates or 1.8% rates, especially if they're getting new into the marketplace. They think that this is the new normal. And so this does change the mindset when it comes to people looking at mortgage applications. So just a couple key obstacles that we're seeing from an investment perspective. We have a lot of people in the past who have purchased pre-sale properties, whether it be 2019 through 2021 or 2022. And a lot of these folks have had some unique challenges, particularly at the very end of 2023. Now, some of these are starting to change, but some things to consider really quickly. We still have a lot of people who purchased pre-sales in, like I said, 2019 through 2021, and these properties are coming up for purchase. And we've seen some serious considerations out in Ontario, a few out in BC, but there are some concerns of of appraisal values. So what I mean by that is you purchased a property for $450,000. When it comes to completion, the actual bank appraiser says, no, this is actually only worth $400,000. And we had about 5 or 6 of these situations in December alone. And most of these clients were able to close, but not without using a home equity line of credit, a inter alia, which is essentially like a private mortgage blanket over multiple properties, or reaching out to friends and family. And ultimately, a lot of these developers are in a position right now where they're serious about suing people who are not closing. So if you have a pre-sale coming up in the next 6 to 12 months, for that reason alone, you should be talking to us on your mortgage team as soon as possible, and you can get approvals in place much earlier than that. The second thing is, with what the new guidelines that have come into place, which I know that there's going to be someone speaking on because they just came out a few days ago in regards to the 2-year flip policy, this could have a massive impact on the values going forward of these units, especially if you didn't have intention on keeping those properties. So just one more reason to have a conversation with your bank broker or realtor about these items. Now, looking at, so we talked a little bit about the shortfalls that we were seeing right there. Delays in timing have been a huge consideration when it comes to these pre-sale properties. Again, that we've seen them push back time and time and time again. It just seems like the same old story. And again, this is actually causing some serious issues when it comes to financing, because we're seeing people wait until the last few weeks or last few days because they've been so used to getting pushed back over and over and over again. And now they're not reaching out about financing until 3 to 4 weeks before closing, which is causing people to actually miss out, have to pay huge fines, penalties, and in some cases completely lose their deposit. So don't do that. Reach out as far in advance as you can, even if it seems kind of silly and way out there. All right. Let's change gears again. We're going to talk about interest rates because everybody loves talking about rates. Like I said, first thing in the morning on a Saturday. Well, first thing that's really important to know is we need to set a stage. I've realized that there's a lot of people out there who talk about bond yields and interest rates, but I think that it deserves a little bit of an explanation as to what they actually are and how they actually work. So what you'll hear commonly when people talk about mortgage interest rates is, especially in Canada, is the Canada 5-year government bond. And the reason for that is typically for the last 10 to 12 years, most people have tracked the 5-year fixed rate, and most banks track that as their baseline when it comes to rate pricing. Now, when you're looking at the bond yield, so this is a little graph here that you can look at going back from 2021 up until today. I mean, it's pretty obvious and pretty clear, as you can see right there, how the bond yields have risen and interest rates have risen for it. A couple things to keep in mind here: as the bond yields rise, you'll note that banks will raise their rates much quicker than if rates go down. When the actual bond yields go down, typically speaking, they will hold their rates a little bit higher for as long as they can and offer discounts. And I'll touch more on that a little bit later, because that is something that most people don't know about. Now, you're typically looking at, if you're trying to understand and you're looking at the rates to try and get an idea as where they will be going or where they're at, you can look at a trend line so you can get a general idea of where interest rates are and if they're on a downward cycle or downward trend, or if they are moving on an upward trend. You're normally going to see fixed rates depending on if it's an insured purchase, which is less than 20% down, or uninsured, as we talked about earlier, going to be about a 1.25 to 1.75, although there is some variance on rates when we're looking at that. The other fact to consider is, so if you're thinking about where rates were at back in 2020, even though the bond market actually, we saw interest rates stay very high when the COVID hit because they had risk-based pricing. They were concerned about where the market was going as far as what was going to happen when COVID occurred. Okay, now where are we at today? We'll talk a little bit about that moving forward here. But as you can see, moving on to the next slide, we are going to show you a completely different graph, and this is thanks to our friend Rob McLister of Mortgage Logic, a really smart guy, does a lot of good writing, and he publishes this graph on a bi-weekly basis and sends it over to us, anybody who subscribes, which you can. Anyways, long story short, typically we should follow the 4-year swap rate as opposed to the 5-year bond yield if possible, although it's hard to find this graph because it's a much better indication of where rates will going and how banks actually price them. In addition to that, the average Canadian consumer keeps their mortgage for around 3.5 to 4 years. So with that being said, it's a much better indication as to the timeline at which banks will use as their anchor point when it comes to mortgage rates. So moving forward here, the other key point, and we're hearing about this, and it gets a little bit deep. So again, I'm going to try to break this one down. U.S. What's going on in the U.S. and how does that impact Canada, both from a fixed rate perspective and the Bank of Canada? Now, I found this little chart here, and I thought you'd find it interesting because typically speaking, everyone suggests that the bond yields and the US Fed and the BOC follows exactly time in and time out. Well, although there is a very strong correlation, there have been a few times in history where we've seen that separate, and we've seen the Bank of Canada, of course, decide to reduce rates before the US Fed. Now, they typically don't want to do that because it'll tank our dollar and cause a whole bunch of other concerns. And we're so closely tied, which is why you've seen this happen historically speaking. But there is a lot of reason to suggest that this time around, the Bank of Canada could make that decision to reduce interest rates going forward. What's more interesting, however, if you're trying to go back and understand this whole bond yield consideration, you'll find that the bond yields are very, very closely tied to what the US Fed says and does. And so if you see good news, typically speaking, you'll see it react positively for rates to go down. If you see negative news, you'll see the opposite. I guess depends on what you see as good or bad news, but have a quick glance at that anytime you hear any news about the US Fed announcements. So what do you do right now when it comes to picking mortgage rates? Now, it's funny because for the last 10 years, the most common mortgage product was a 5-year something, 5-year fixed or 5-year variable. Now, all of a sudden, anywhere and everywhere, all you're hearing about is the 3-year terms being advertised. And for a good reason. It's kind of a win-win when it comes to the banks and for the consumer for a lot of reasons. Although the bank would definitely prefer to get you on those 5-year fixes, people aren't dumb and they are choosing and understanding that the market itself is likely to come down over the next 12 to 36 months. With that being said, they're offering better discounts on a 3-year term, substantially better than what you're seeing on, say, a 1 or a 2-year, because the cost of funding is so much higher. So what we've seen right now, just to give you a reference point as of this week, a large bank on a 30-year fixed mortgage right now, so a 3-year term, we see 2 years at about 5.89, 3 years at about 5.29, and variable rates at about 6.8, which is about prime minus 40. And these are the preferred rates. So these are people who are well qualified, able to get into a mortgage. One thing to note is they are offering some discounts depending on where the bond markets are at any day, which again, we'll get into a little bit more as we get to the presentation. The 3-year fixed right now does provide a few key advantages that you could consider going into the marketplace. Like first and foremost, there's going to be a lot of uncertainty this year, next year, and the year after. So there is a lot of advantage from that perspective, but there is a pricing advantage, which we'll have a look at. The one thing to look out for a lot of people who are in the investment space is you have to be mindful of the interest rate differential penalty, which is a substantial cost, even on a 3-year fixed rate mortgage. And we're going to see that actually get worse and worse and worse as the bond yields hopefully decide to come back down as the posted rates from the banks change. This impacts fixed rates. That's going to get a little bit much. But in short, if you're taking any type of fixed rate term, be conscious of the cost to break it. Short and sweet. Now, here's a quick little math just in case you're trying to have a little bit of an understanding as to where it's at. On the left side right here, this is based on a 3-year fixed. Sorry, my apologies. The rates I'm looking at here are a 3-year fixed at 5.29 versus a variable, prime minus 45, assuming a good discount. And we're also suggesting this is an ARM, which is an adjustable rate where the payments actually go up or down. This is based on the assumption that the Bank of Canada reduces rates up to 2.25% over the next 30 months, which is basically what we've seen projected recently. The 3-year fixed itself does work out better for a borrower from a mathematical perspective on $500,000 based on this specific scenario. So there you go. You have the math right there that you can have a look at. There's some quick tips and hacks to get a little earlier if rates go down, but that's a one-on-one conversation that I have with someone else. Other good reminders, the market itself is still anticipating. It's like been a roller coaster. We went from, hey, the bank's holding, oh, things are really bad. We're going to see rates push back. Oh, and then all of a sudden we have this Canadian inflation data that came back down. And now we're thinking, well, this could mean good signs for the Bank of Canada to reduce rates earlier. Anyways, with that all being said, a couple little notes right here. This will show you any time where the Bank of Canada has increased rates over 1% over the course of a rate cycle, they've come back down mathematically or as an average over 33 months. We're about 24 months into this cycle, so it would be reasonable to suggest that over the next 12 months, we could also see rates come down by at least 1%. And I don't think that's too far off base based on the statistics that we've kind of seen come out and the information. Quick little implied rate graph, as you can see on the right-hand side in the red, that's a suggestion of likelihood of, the right-hand side shows you how much of a reduction we would see in interest rates over the course of the next period of time. So they're suggesting that we'll see about 75 points of a Bank of Canada rate adjustments, which would be welcome news for all those investors and homeowners who are currently carrying very high monthly payments on their existing variable rate mortgages. Some other key tips if you're getting into the marketplace right now. Why are house prices going up so quickly? Well, besides the fact that we have this low supply, besides we have demand and the excitement of the marketplace, people can qualify for more. The primary thing is it doesn't even matter what the Bank of Canada does right now because fixed rates themselves have gone down and people can only qualify based on the lowest rate on a stress test. So with the rates having gone down even 1.25% since October of 2023, there is a borrowing power increase of at least 10% across the board, in some cases, even more. So for that reason alone, we're doing updated pre-approvals every single day right now. And people are saying, wow, okay, I've got another 50 grand, another 100 grand, another 150 grand. And they're going out and they're looking in that new price point. So they are spending that money. Other good news is that we've seen some of the major lenders, First National and TD, just increase their sliding scales. This is basically the percentage of money that they're going to lend on a high value property. They've actually increased their guidelines on that, which is a reminder that they believe that property values are going up and they're here to stay, which is another good sign. Now, I touched on interest rates briefly. I think this is something really key for people to know. There's so much confusion about the rate market, people Googling it up, looking at Rate Hub, talking to different banks, talking to different people. At the end of the day, if you're working with someone who has what we call status, which our company does, thankfully, we can get discounts that are typically between 0.25 to 0.35% lower than any bank's typical advertised rate. Now, the bank itself has the ability to reduce rates, but they typically won't because they eat into the branch manager's profit, whereas on our side, it doesn't have any impact on our ability to qualify or get paid for that matter. So we're seeing a lot of people looking at rates today as the be-all, end-all, and taking whatever is offered to them and or a small negotiation. Whereas with our status, we have the ability to negotiate, as I was showing you, a current fixed rate with Scotia on a 30 years advertised at 569 to 579, and we're seeing 519 to 529 on a regular basis. Just to give you some context, that's a lot of money that you're losing if you're out there kind of shopping with your own bank right now. So where do we go from here, and what does the market suggest as far as moving forward? We got a couple key things to consider here, a couple key options. I don't know how much time I have left, so maybe we're coming up on 4 minutes. All right, so we're going to make this one as quick as we can. I wanted to show out 3 different scenarios to give people an option based on where the market could be going. Now, obviously, I think in the last few weeks, some of this data has changed, and I started preparing this a few weeks ago, so perhaps that'll lead us into knowing exactly which bet that we're going to be taking. But here's the information nonetheless. A couple things to keep in mind. We do have people, obviously, but we just talked about looking at the adjustable rate mortgage. Very important. Don't look for a variable rate. Make sure to look for adjustable rate. The only big bank right now that's offering that product is Scotia. None of the others do. That's where the payment reduces if you are a variable rate holder. Now, the 3 different bets that you could be making in this marketplace. Number one, which is a high likelihood of rates coming down by mid to late 2023, fueling obviously a 10 to 15% increase in home values, perhaps even more. I'd love to hear some feedback from the other folks on the channel. Number two, a 20 to 30% chance for delayed rate cuts, so things holding off because of some other negative impact, which could happen at any time, resulting in a small dip in property values, even though they've already increased. And then the less likely scenario where there's a rate hike, which is highly unlikely at this point right now. So the first scenario, probability, as I mentioned, 60 to 70% chance at this point right now. Now, I wrote this right before the inflation, so I've already put this right here. Already has happened, based on the assumption that the Bank of Canada sees core inflation dip below 3%. And obviously, there's a lot of suggestions that we will see inflation continue to go down over the course of the next few cycles. At this point right now, we've already seen that happen, so it does provide positive momentum for this particular likelihood, with so many different mortgages right now, as we're seeing at around oh my goodness, sorry guys, with the breakdown being at 80% loan to value at today's prime rate, so prime minus 75 right now, there's about $124,000 of interest over the 5 years. If we saw a 10 to 15% increase in home values, which is an average growth of $82,000, there is a significant gain for somebody buying in the market right now, with the only risk being that there may not be as much in the form of rate cuts. So if we did see that 10 to 15% value growth, it would be based assuming there wasn't the rate cut, just subjectively on supply and almost nothing else. Obviously, I believe that this is the most likely outcome right here, where we do see a significant growth in most markets. Nonetheless, I hope that made sense for everyone. That's the first bet that you'd be making. Bet number two is the assumption that we don't see any significant rate cuts this year. So a borrower who takes prime minus 75 would face about $129,000 over the next 5 years. It's about $5,000 more, and it could lead to a small decrease in home values in certain markets, which is possible because if we're talking about the entirety of Canada, this would affect more of the short-term investor versus the long-term investor, which it seems like most people are leaning towards the long-term right now anyways. So the only major impact to folks, if this actually happened, was to the quote-unquote flippers, which I think are exiting BC at this very moment based on the most recent news anyways. So I'd say in bet one or bet two, whichever way that you go, the actual valuation long-term would be fantastic. The only thing you have to be fearful of is this very low probability of a BOC rate hike, which I'm sure someone will touch on as well later today. Very, very limited chance. The only thing I want to note about this, because everyone thinks that it's a perfect linear path down, there is no perfect linear path down or up for that matter. And so just like we saw with COVID when that happened, some of the unexpected surprises that have occurred over the last little bit, it is still very possible that there could be some negative impact in the marketplace. Very limited possibility, but we just kind of keep people in mind that these things can happen. I think the risks here are very self-explanatory. Again, I think long-term valuations is still positive, but those are the 3 bets that you're making if you're considering the marketplace, looking at where things are going. Regardless of the uncertainty of what's happening right now, just a couple of anecdotal pieces of evidence or feedback as we kind of end off the conversation. First and foremost, I showed you guys the bond yields. This is not going to be a perfect kind of downswing no matter what we do. We see the markets go up and down on a day-to-day basis. It's constantly evolving and constantly changing right now. And so for anyone getting in right now, it's just hold on to your pants, make sure whatever you're doing, you're holding on for the long term and making a good decision. I see no reason or cause for concern for anyone investing in this current marketplace. And I think the potential for equity gains, even if you buy a month month from now when the market is already heating up is still going to be fantastic in nearly all markets. My only consideration for virtually anybody getting into the mortgage marketplace right now, especially as an investor, is to be hyper conscious of your financial stability, because one of the biggest mistakes that investors are making and have made traditionally, but they got away with forever, was having their own cash or backup plan, if you will. We don't see enough people having that right now, and that's where people are having to sell off or lose properties at losses because the market only went up for a year or 2 years. So just be really conscious of those things. Whew, there we are. So that was a lot of information today, guys. I really appreciate it. If you like this, I got a podcast where we go a little bit deeper on this stuff. You can scan this little bad boy right here if you want to follow, and appreciate you all coming on today.